Welcome to Policy on Demand. I'm Thomas Groenen. We're filming at PwC's 6th International Tax Conference. Joining with me today is Puneet Arora to talk about the emergence of retail funds for private investors. Welcome, Puneet.
Thank you, Thomas.
So, businesses across all sectors are looking to scale and grow their customer bases. And asset and wealth management is no different. And we've heard a lot recently about the so-called retailization of alternatives. In fact, I've heard certain industry participants refer to this as a 4 trillion opportunity to develop new products. And over the next few years, the capital raised from retail investors will exceed the capital raised from traditional sources, institutional investors. Puneet, could you elaborate on what's driving this trend and what types of new products you're seeing emerging?
Of course. Thank you, Thomas, for having me. So retail investors, by any measure, is about $90 trillion of capital. So far, 4 trillion of that is invested in alternatives. And that's the high net worth and the family offices for the most part. And now retail investors are getting access to these products, and the expectation, like you said, of 4 trillion is the next 5 years. So if you take 90 and say 10%, it's going to go from 5 to 10%. It's not inconceivable. In fact, it's a good trend. What is driving that is that they're taking a longer term view, the retail investors, and there's diversification that they want in terms of investment opportunities. So that's really what is driving the trend. The type of products we are seeing, if you look at Europe, it's the LTIFs, which is the UCIT version for alternatives.
Yep.
There is the Part 2 funds, and in Luxembourg, for example, and you can set up similar funds in other jurisdictions, investor-specific funds, or the traditional RAFs. As you know, those are products that have been used by the industry for a very long
Number
time.
of years, yeah.
US products still remain, a partnership product, which is most popular. The question is, could we end up with using a regulated product like a RIC and a REIT, and that those already exist, and the question is how far those can tap into that pool of capital. And there's a PFIC type product. There's been so far reluctance around that, but that is definitely part of the consideration of the discussion. So if you look at this capital, you look at products, there's probably more that are going to emerge, but that trend is well on its way, and it's a very encouraging and positive trend.
Interesting. So clearly the size of the opportunity, 4 trillion, is undoubtedly attractive. And alternative firms, rightly so, will be evaluating, pursuing this new channel. But if I step back and think about it, having lots of small ticket investors versus the historic operating model, a few large institutional investors, is naturally going to create additional burdens on compliance and operating teams within an organization. How should alternative investment firms think about scale and position themselves for success to cater to the demands of this new investor base?
Yeah, Thomas, this is exactly something that the people are dealing with anywhere right now. The tax function is having to do a lot more, and the scrutiny and the law changes that are coming through is putting a lot of pressure on standardization, reliance on technology, looking at your data and being able to use it in an efficient way. If you think about these products, you're going from an organization that's dealing with a few hundred investors, maybe a few thousand, to many, many thousand, right? Tens of thousands of investors. So you think about tax compliance at the product level. Investor reporting is a huge burden, and it could work. It will vary based on the location of the investor. And now you're talking multiple investor jurisdictions. There is the tax provision piece of it in a liquid product. With even though there is liquidity itself is not a daily liquidity, but it is a monthly, quarterly liquidity. You can imagine how much pressure that puts on tax provisions and the tax accounting and tax having to work with operations, finance, legal, and so many more departments at a more regular level with size. And then there's structuring. You're constantly being asked by a group of investors of how they can be accommodated in a different way, and structuring of this product continues to be evolved and get more complex. So it's a lot of it ultimately, it is about standardization. It's about processes. It's about what level of automation you can do and how to use your data.
Yeah, and this is in addition to the traditional role of the tax function, which is to help the deal teams structure the investment opportunities in the most efficient way whilst managing risk in an appropriate way.
Correct.
And maybe that's a nice segue into the role of the tax function more generally, both in terms of the design of any new product and then the ongoing operational management. Clearly, tax should be at the table as their investor relations, business teams are looking at this opportunity to ensure the sustainability and future success of these new products.
Absolutely. So if you look at the distribution teams, they're looking at the tax function to help set up the right type of product, because if the investors, in order for them to be taxed in the appropriate way, require reporting, the question is, can we get that reporting? At what point does it become, is it scalable enough that you do that for different jurisdictions? Do you need to go get agreement with the tax authorities up front on certain things? And so there is a huge role that tax plays in terms of this product itself. There's then the question of liquidity, financing, treasury, hedging, and how do you sort of provide liquidity within the product as you deploy capital and and the like. So there is that which is much more enhanced, but tax plays a very active role in there. Ultimately, I think where tax will play and be more prominent is in having, like you said, having a seat at the table up front, because you will set up the right type of expectation, and the disclosure and the in the offering memorandum is appropriate to what can be done, should be done, and what the investors expect to be done.
Yeah, and I think this all touches upon the investor experience, which has always been paramount in the industry and will be particularly the case as we're dealing with a disparate group of investors, as you said, in different geographies with different needs and sensitivities.
Yep, I agree.
Well, Puneet, thank you very much for your time today and your insights. As always, thank you for your time with us, and we'll see you next time.